All right, for years now we've watched the markets just climb and climb, right? It feels like it's all fueled by this unstoppable wave of innovation. But what if the biggest risks are the ones we're not even seeing? Today, we're going to dive into a pretty interesting forecast that looks ahead to 2026. We're going to explore some of the hidden forces that might be setting the stage for a major market shift. And you know what? It all starts with one single, powerful emotion.
Man, this really just gets to the heart of it all, doesn't it? When absolutely everyone believes the market can only go up, well, that creates a really dangerous blind spot. People stop asking the hard questions, and risk, it gets totally swept under the rug. It's this exact feeling of security that so often lays the perfect groundwork for the biggest collapses.
And that leads us right into our first big idea, the confidence trap. We're about to see how today's market, with all of its tech-fueled optimism, actually shares some pretty eerie similarities with past cycles of boom and bust. I'm talking about things like the dot-com bubble and, of course, the 2008 crisis.
So on the surface, things look great. Unemployment is stable, people are spending, it feels comfortable, you know? But the analysis we're digging into suggests that this late cycle stability, that's the real danger. It's kind of like that calm, beautiful, sunny weather just before the storm is forecast to hit. It's precisely when everything feels certain that the ground beneath our feet can start to crack.
This is just a fascinating parallel. Think back to before 2008. The unshakable belief was in housing. Prices could never go down. Well, today, that same kind of blind faith is being placed in corporate valuations, especially in the tech world. The underlying structure is identical, a powerful belief that future growth is basically guaranteed, which can pump up asset prices way, way beyond what they're actually worth.
So let's peel back that confident surface and see what's really going on underneath. In this next part, we're going to go searching for the hidden cracks, all those pressures that are quietly building up while most of us are looking the other way.
The core concept here is something called systemic fragility. Now, this isn't about one bad company or a single bad investment. Now, this is about the entire financial system becoming, well, brittle. It's become way too dependent on good vibes, easy money, and the lightning-fast speed of digital transactions. And when the system is that fragile, even a small shock can have absolutely massive consequences.
So where is all this fragility coming from? Well, the first major pressure point is debt. For years, borrowing money was super cheap, but now all of a sudden, trillions in corporate debt have to be refinanced at much, much higher rates. And this isn't just about paying more interest, it's like a slowdown of the entire corporate metabolism. Money that could have been used for innovation is now just going to service old debts.
And the second crack? It's in the workforce. Look, AI and automation are incredible for productivity. There's no doubt about it. But they're also getting rid of jobs faster than a lot of people expected. What that does is create a really insecure consumer base. And if people are feeling uncertain about their future paychecks, guess what? They spend less. And that slowdown just ripples through the entire economy.
Okay, so you have these hidden cracks, right? Debt on one side and workforce instability on the other, both building up under the surface. This brings us to a really critical question. How could this whole thing actually play out? Let's take a look at the anatomy of a potential fall.
This slide basically lays out the domino effect of a modern crash, and man, is it alarmingly fast. It all starts with a trigger, some unexpected event that just shatters confidence. Then, boom, automation kicks in. We're talking AI algorithms selling in microseconds. That move is then amplified across social media, spreading panic way faster than actual verified information. And that leads to forced selling as big institutions have to dump assets to cover their losses, which finally triggers a market halt. It is a perfect storm, and it's all driven by technology.
Let's dig a little deeper into that last point, because it's absolutely the critical difference maker here. The next potential downturn could be fundamentally different for one big reason: technology. It's an accelerator. It makes everything faster, more connected, and honestly, far more unpredictable than ever before.
And here is the fundamental difference. On the left, you've got human traders. We pause, we think, we analyze the context. On the right, you have algorithmic trading. It's pure data and speed. The algorithms see a negative trend, and they execute instantly. And because so many of them use similar data, they can all start selling at the exact same time, which just amplifies the crash.
And it's not just the pros anymore. The danger now includes social media-driven panic. We literally have millions of investors, many of whom have never ever seen a real crash, getting their financial news from influencers. A single viral post spreading fear can now trigger a massive, emotional, and simultaneous sell-off from regular investors all over the globe.
This profile of the modern investor really tells a crucial story. You've got a huge segment that's younger, heavily influenced by what they see on social media, and with almost no experience of a real downturn. And they're doing it all from an app on their phone. When you combine all of those factors, you get a totally new kind of volatility, one that's faster, more emotional, and that our traditional financial models just aren't built to handle.
So, after exploring the setup and the potential fall, where does that leave us? Well, this brings us to our final section, the great rebalance. Because after every fall, there's an aftermath. What might that actually look like?
I think it's so important to look at this from two perspectives. On one hand, a fall is painful. It means lost wealth, a slowdown in the economy. But on the other hand, history has shown us that these events are often a necessary correction. They act like a system reset, clearing out all the excess speculation and forcing the market to become more resilient and grounded in real-world value.
But, ultimately, the biggest impact isn't just financial, it's psychological. It's a huge blow to confidence and to our trust in the system. So a true recovery isn't just about watching the stock market numbers go back up. It's about learning from the mistakes of being over-optimistic and rebuilding everything on a stronger, wiser foundation.
And that really leaves us with this one final thought. Market cycles are a natural part of our economy, simply because they're driven by human nature, our greed, our fear, our hope. So the real question isn't if a correction is going to come, but when it does, what are we going to choose to learn from it? Thanks for joining me on this exploration.